Hello again. We are now going to finish Chapter 11 over investing in equities, futures, and options markets. You should have the blank copy in front of you, and we're going to fill it all in as we go. But hopefully, as we go through this, I'll be able to give good enough examples that will enlighten you as to different aspects of investing and what they look like and some of the considerations you need to think about when investing. But again, we're going to go ahead and start with the 11.3 handout. And at the beginning it says equity. Again, we're investing in equities. Well, what's an equity? It could be like a share in common stock, which means it's ownership. Equity means ownership of a financial asset. Now, for instance, let's say I own a $300,000 house and I have paid $150,000 of it already. That means I have equity of $150,000 in the house, but I still owe the bank $150,000. Now, banks and other financial institutions will allow you to borrow against that equity. Some of you have heard this term, a home equity loan. Just to give you an idea that equity represents ownership, and we're going to be talking about stock ownership typically, or options or future ownership. So hopefully that helps clear that up a little bit. Now, one of the concepts, like I said, when considering investing is interesting. The idea that you can't beat the market regularly. EMH stands for, if you want to write it down, efficient market hypothesis. If you remember, I don't know if I shared this with every class, but the idea, I interned for a summer with a broker, and he said a monkey could come in and pick a stock just as good as he could at any given time. What he was saying was that it's hard to predict on a daily basis what the market might do. And you can't just predict and beat it regularly, or all of us would be rich. So you can't just predict it and hope you're going to make money every time you do it, because we don't know what's going to happen some days. There could be a terrorist event that could kill the stock market. You know, there's all kinds of things that could come into play that could affect that. Next, the strategy of holding different stocks or funds so changes in value can be offset is called portfolio diversification. Now, I'm going to show you this, and I assume it's probably backwards a little bit. I'm not sure how you see it. But the pie chart represents a really good diversification of an investment in stocks or funds. You can see here on the left of this, it could be your right, not sure, but these are the different types of stock that one might purchase. Let's say, for instance, one here, let's say PepsiCo or Walmart under consumer staples doesn't do real well. Well, that might be okay because you might have technology like Dell or Intel or Microsoft that can make up for the difference of that particular stock, like PepsiCo, not doing well that day. It's the idea, don't put all your eggs in one basket. So you diversify. You might, like this is broken up in different percentages of what to invest in. And financial planners or brokers will suggest these type of things so you don't lose money just because of one stock value going down. Very important. Now, a real good example of this, which a lot of people invest in, including myself, are mutual funds. It's kind of a poor man's way to invest, I guess, if you want to call it that. Here's an example of a fund I used to own called the Washington Fund. And this is how they broke up their stock. They would buy a variety of different stock in different companies. And if you can see that, things like, I don't know if you can see the term consumer discretionary on the pie chart, but you know, that might include things like from Home Depot, Comcast, General Motors. You notice also there's a consumer staples section here in the pie chart. That might include like Coca-Cola, CVS. There's healthcare on there also, like that could include Aetna, which is a large health insurer, Abbott Laboratories, you know, for pharmaceuticals, things like that. But the point is they diversify the mutual fund, and hopefully if one part of that fund isn't doing well, it can pick the others up. And obviously they average all those prices over all the funds to come up with a portfolio value for that fund. And you can own many mutual funds. Even at your age, you can even start one, I believe, at 18, or a parent can co-sign. And in some mutual funds, you can put as little as $25 in a month to do that. But it's a really good way to invest. And you notice it, like it says, this is a company that sells stock in itself. Like, it accumulates this stock and it takes the money and buys other companies for you. And I don't know, I found it over time, like if you remember the compound interest spreadsheet, that strategy is pretty good over time if you stick with a mutual fund company. Next, the 401k plan, which we've talked a little bit about already, an IRA type plan, which is tax deferred, and it's like a personal pension fund. The big advantage is it's portable. If I quit a job one place that offered me a 401k, I can take that with me to my next job. And again, could be tax deferred. Like we said in the last time, the Roth IRA is tax deferred at the end when you take it out. A traditional IRA in the 401k plan might be one that's taxed when you take it out, but not at the beginning when you put the money in. The New York Stock Exchange is a place where people do purchase stock, and it tends to be like the Super Bowl of stock markets, and you can see the size of it here. And you have to have a membership to access the trading floor. Like Edward Jones, they have a membership, and they hire people to actually go purchase stock. And the stock exchange does it in New York traditionally, where people literally run around with their heads cut off in these little bright orange or yellow vests buying and selling stock. They scream all day, and they raise their hand, or they do hand signals like buy, 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 sell, sell, sell. And it's just a traditional way they do it. They obviously don't have to do it that way, but based on tradition, they stick with that. A lot of transactions end up taking place through a computer. But that's kind of like the Super Bowl of stock exchanges. The American Stock Exchange, now, by the way, New York Stock Exchange, if you notice, is for large companies. The American Stock Exchange are for medium to smaller size companies. And it's a little more speculative. And if you remember what that means it's a little more risky. Regional stock exchanges exist in the United States also that might be new companies, or they're too small to be on these two, like Boston, Philadelphia, San Francisco. They have regional stock exchanges, and no, Indianapolis does not. Chicago has a very large regional stock exchange there also. And so people get their start there. Now, most of you, including myself, will make a majority of our trades on over-the-counter markets, OTC markets. The most famous OTC market is called NASDAQ. Probably have heard of that term before. It means National Association for Security Dealers Automated Quotation System. It's all done electronically through a computer. So you purchase stock electronically. Like, that does make sense to us. Like I said, these other exchanges may do traditional methods where people literally run around on this trading floor and make paper purchases, and they yell at each other all day to make those purchases to either, higher prices or lower prices. The Dow Jones Industrial Average is a key indicator of stock performance around the world. Now, again, the Dow is not something everybody even has stock in, because this, you might want to note next to this, that this represents the New York Stock Exchange. I'll show you this real quick here. These are the Dow 30 companies that represent the Dow indicator. They will take all these and average them together to come up with a average. It's not literally prices, though. I mean, these are the prices of the stock, but they use a divisor. Thank goodness we don't have to mathematically know how that's figured. But they'll use all these companies you can see, very large blue chip stock companies, but they're from different areas like finance, technology, manufacturing, oil, You got consumer goods, like Johnson & Johnson, Coca-Cola, McDonald's. So it's a variety of stocks that they will take their prices and average them real time to come up with what the value is at any given time. Now, for instance, at the end of the day yesterday, let's see if I can find it here. I might have to go to another page. I apologize, to find out what the price is. Well, anyway, I'm not having success finding that, so we're going to move on. But that's just a measurement. And, some people will, jump out of windows if the Dow Jones drops. I believe it went over 19,000 for the first time. I believe it was last week. And a lot of people think that's an election bounce because of Trump winning. Who knows for sure? But people are excited about getting in the market right now, and we'll see if that continues. I don't know. Maybe stocks will become overvalued, and then they'll have to correct themselves, and actually there might be a correction or a quote-unquote crash later. Standard & Poor's is another way to measure stock prices, but they take 500 representative stocks. Dow Jones, remember, is 30. Standard & Poor's does 500. You could argue saying Standard & Poor's might be a little more accurate because of that, but we can't say that for sure, but because a lot of people put weight in the Dow Jones because those represent some of the larger companies. These two terms, again, make sure you understand the difference between a bull market and a bear market. Bull market means prices are moving upward for an extended period of time, usually 6 months. Same with a bear market being 6 months, but prices are falling for an extended period of time. People might say we're in a bull market right now because of the fact that prices have gone up over the last year. A spot market is where transactions are made at a prevailing or current price. That's like the people that are calling in and getting the prices right off the floor right at that time, current as possible. Most people, like you and I, will not trade that way when we're investing for retirement. Whoever we buy our stocks through, they may purchase it today, tomorrow, whenever, at whatever the price is at that time, and they're not that worried about it because we're investing for the long term. So spot market, people are like day traders. They're wanting quick turnaround. Now here's the ones that can be confusing. A futures contract. As you can see, a futures contract is an agreement to sell at a specified date and predetermined price. Now if you look at the screen up here, these are examples of where you buy and sell future contracts. The New York Mercantile Exchange, the Chicago Board of Trade, they call it CBOT, the Chicago Mercantile Exchange. There's a climate futures exchange, which if you look at this card, there's actually a former Carroll student I had that he sells weather on that exchange. Figure that one out. The point is, you're making a decision whether to purchase something at what the price might be in the future. You can see in the highlight some of the things that people purchase in future contracts: grain, beef, oil, orange juice, natural gas, etc. People do this because they feel they have an idea of what they're going to make in a profit in the future, so they have this contract that lasts typically only a year before it's up when the purchase has to be made or a sale has to be made. Now to quickly finish out the notes, you can actually buy an option in the futures contract where it'll give you the right to cancel a contract, which again, now you have to pay for this, but it gives you an opportunity to maybe have more control over what happens to the price in that. There's a call option where you have the right to buy that share of stock at a specified price. Or there's a put option where you have the right to sell that share of stock at a specified price. And again, if you'd like to see more on these, just look up in Investopedia.com how to buy futures products. It's a little more complicated, but people like it because they feel they have a little bit more control over how they invest. And some of people use it as a hedge, meaning they use it to possibly make money where other products they invest in are losing money. Thank you for listening today, and I hope this has helped with Chapter 11 information.